In Chapter 6, we will be learning how to record, summarize, and present the business transactions for a merchandising company. Now, we're going to do that over 3 videos. To this point in your study, we have only talked about service companies. Now, service company provides a service, and therefore it recognizes revenue when it provides a service, and it matches against revenue the expenses incurred in providing that service to give us the net income. A merchandise company, by contrast, doesn't provide a service. What it provides is a product. They did not manufacture that product. They purchased in that product. They did not change the product in any way. They simply put a price tag on it or put it on a hanger or what have you, put it on the shelf, and the customer came in and purchased it. So you see, we have some new accounts. When we sell something, we recognize, let's say we sold it for 100. But what the item we sold for 100, we had to buy ourselves. Let's assume we paid $60 for that. That's called the cost of goods sold. The difference, 40, is called my gross profit or my gross margin. So here we have some new terms. Sales revenue, sales instead of service revenue. Cost of goods sold, which is the cost of the item I purchased and sold to my customer. The difference is the gross margin. From that, we then subtract our operating expenses to give us our net income. So some new terminology. Now, how do we record these transactions? Well, looking at how we record the sale of a merchandise, when a sale is made for cash, the company simply debits cash, because cash count went up, and credits the revenue account. Now, sometimes we just use the term sales, but that is our revenue account, so we credit revenue. If we made the sale to a customer on account, that means the customer has an account with us, well, we simply debit accounts receivable and credit sales. Now, because we're selling a product, we could be selling it at a discount. And we offer sometimes to our customers terms of sales. 2, 10, and 30 will be on the bill, which means that if the buyer pays within 10 days of the invoice date, they may deduct 2% of the sale. If the payment is not made within that discount period, then they must pay the whole amount in 30 days. So therefore, a cash discount is a deduction from the invoice price can be taken only if the invoice is paid within a specific time period. Let's assume on July 12th we sold to a customer on account, and we gave them the terms 2, 10, net 30. All right, debit accounts receivable 2,000, credit sales 2,000, just as we've done before. Terms there. Now, before 10 days are up, the customer pays. Well, the customer cancels the accounts receivable by paying. So we credit accounts receivable. But they didn't pay us $2,000 in cash. They took a $40 discount. That $40 discount is a 2% of $2,000. So the journal entry then would be the cash we did receive, debit $1,960, debit sales discount, and credit sales. Now the sales discount is what's called a contra revenue account. That is, sales has a credit balance, so sales discount, instead of debiting 40 here, sales, we set up a contra account. Contra means opposite, and we put the debit in here. So we say sales 2,000 less sales discount of 40. Okay, unlike a service company where the company provides a service, you can't return the service or get an allowance for it. But a merchandise company, the customer can return the goods and or wants a allowance. That is, I'll keep the goods, but I want you to give me back some of the money I paid, or I'm not going to pay you the full amount. Assume a customer returns 300 of goods sold on account. Well, what we do is we set up a sales, returns, and allowance account. Sales is, and this too is a contra revenue account. We debit it, 300, and we take the customer out of the accounts receivable and we take them out. So there's our journal entry when it is returned, when the goods are returned. Now, how do we show this on the income statement of a retail company? Well, here we have just the partial, just the beginning sales. So we have gross sales, $282,000. But we say less sales discounts, $5,000. Less sales returns allowance of $15,000. Now, because we're adding them together, we move to the inside column. We carry the total out here, and we subtract it, and we get net sales. So net sales is gross sales minus sales discount minus sales returns and allowance. Now, in our accounting records, sales is a credit balance account. And sales discount and sales returns allowance are contra accounts. They're debit balance accounts because they will be subtracted from gross sales to get its net sales. Next, we will look at the cost of goods sold section.